In this video, we will delve into the fundamental concepts that every aspiring real estate enthusiast should grasp. Whether you're looking to buy your first home, invest in rental properties, or simply expand your knowledge of the real estate market, understanding these key concepts is essential. Throughout this video, we will cover a range of topics that are crucial for beginners to comprehend. We will discuss different types of homes, the ins and outs of mortgages, the concept of equity, the benefits of renting versus buying, and much more. By the end of this video, you'll have a solid foundation in real estate basics that will empower you to make informed decisions in the future. Learning about these key concepts is not just about acquiring knowledge, it's about gaining the confidence to navigate the complex world of real estate. Whether you're a first-time homebuyer or a potential investor, the information shared in this video will provide you with practical insights that can help you make smart choices and achieve your real estate goals. Home types. Exploring different housing options when it comes to purchasing a home. There are various types of properties to consider, each one with its own unique features and benefits. Single-family homes, duplexes, condos, and townhouses are among the most common options available to potential buyers. Understanding the characteristics of each home type can help you make an informed decision that aligns with your lifestyle and preferences. Single-family homes are standalone properties typically situated on their own lot, offering privacy and space for families. Duplexes, on the other hand, consist of two separate units within the same building, making them a popular choice for investors or homeowners looking to generate rental income. Condos are units within a larger complex, providing amenities such as shared facilities and maintenance services. Townhouses are multi-level properties that share walls with neighboring units, offering a balance between privacy and community living. Popular neighborhoods where single-family homes are commonly found include suburban areas with spacious yards and family-friendly amenities. Duplexes are often located in urban neighborhoods with a mix of residential and commercial properties. Condos are prevalent in bustling city centers or beachfront locations, offering convenience and luxury living. Townhouses can be found in both urban and suburban settings, providing a blend of privacy and communal living. For first-time homebuyers, key considerations when choosing between these options include budget, maintenance responsibilities, location preferences, and future resale value. By weighing the pros and cons of each home type and assessing your individual needs, you can find the perfect property that suits your lifestyle and financial goals. Mortgage. Navigating the path to homeownership. A mortgage is a loan provided by a financial institution, typically a bank, that enables individuals to purchase property by borrowing a specific amount of money. This loan is secured by the property itself, serving as collateral for the lender in case the borrower defaults on the loan. One of the key requirements of obtaining a mortgage is making a down payment, which is a percentage of the property's purchase price that the buyer must pay upfront. When applying for a mortgage, lenders assess various factors to determine the borrower's eligibility and the terms of the loan. These factors include the borrower's credit score, income, employment history, debt-to-income ratio, and the property's value. A higher credit score and stable income can increase the chances of mortgage approval and secure more favorable interest rates. Down payments play a significant role in the mortgage process as they impact the overall cost of the property and the loan amount. A larger down payment can lower monthly mortgage payments, reduce interest costs, and potentially eliminate the need for private mortgage insurance, PMI. For beginners navigating the mortgage application process, it's essential to start by reviewing and improving your credit score, saving for a down payment, and getting pre-approved for a mortgage before house hunting. Researching different loan options, comparing interest rates, and seeking guidance from a mortgage broker or a financial advisor can also help streamline the process and increase your chances of securing a mortgage that aligns with your financial goals. By being proactive and informed, you can embark on your home ownership journey with confidence and clarity. Equity. Building wealth through real estate investments. Equity in real estate refers to the difference between the current market value of a property and the outstanding balance of the mortgage. As homeowners make mortgage payments and property values appreciate, equity grows over time, representing the ownership stake that individuals have in their homes. Property appreciation and mortgage payments are two primary factors that contribute to the growth of equity. As the property value increases due to market trends or home improvements, homeowners can build equity without additional payments. Mortgage payments also play a crucial role in building equity, as each payment reduces the loan balance and increases the homeowner's ownership stake in the property. Equity serves as a valuable asset that can help individuals build wealth and achieve financial stability. By increasing equity in their real estate investments, homeowners can leverage their properties for future financial opportunities, such as accessing home equity loans or lines of credit, funding home renovations, or using equity for investment purposes. For beginners looking to boost equity in their real estate investments, strategic approaches include making extra mortgage payments to reduce the loan balance faster, increasing property value through renovations or upgrades, and monitoring market trends to capitalize on property appreciation. Additionally, maintaining the property's condition, staying current on mortgage payments, and seeking professional advice from real estate experts can help beginners maximize their equity growth potential and secure a solid financial foundation for the future. By understanding the power of equity in real estate, individuals can unlock opportunities to build wealth and achieve long-term financial success. Renting and leasing, generating passive income through rental properties. Renting a property involves leasing it to tenants in exchange for monthly rent payments, which can help cover mortgage expenses and potentially generate cash flow for property owners. Becoming a landlord for rental properties offers a range of benefits and challenges that individuals should consider before venturing into the rental market. One of the primary advantages of being a landlord is the opportunity to earn passive income through rental properties. By renting out a property, owners can generate regular rental income that can supplement their finances and contribute to long-term wealth building. Additionally, Rental properties can appreciate in value over time, providing owners with potential capital gains when they decide to sell. However, being a landlord also comes with its challenges, such as finding reliable tenants, managing property maintenance and repairs, handling tenant disputes, and navigating legal responsibilities. It's essential for landlords to conduct thorough tenant screenings, establish clear rental agreements, and maintain open communication with tenants to ensure a positive rental experience for both parties. To maximize the benefits of renting and leasing properties, property owners should focus on finding reliable tenants who pay rent on time, respect the property, and adhere to lease terms. Implementing effective property management strategies such as regular inspections, timely maintenance, and response communication can help landlords maintain rental properties efficiently and enhance tenant satisfaction. By approaching renting as a source of passive income and implementing best practices in property management, landlords can create a successful and sustainable rental business that generates long-term financial rewards. Using a management company to manage tenants can be a beneficial strategy for landlords, especially those who want to minimize the day-to-day responsibilities of being a property owner. These companies specialize in handling tenant relations, rent collection, property maintenance, and other administrative tasks, allowing landlords to focus on other aspects of their investment portfolio. One of the primary advantages of using a management company is the time and effort saved. Landlords can avoid time-consuming tasks of tenant screening, rent collection, and maintenance coordination. This is particularly beneficial for landlords who own multiple properties or live far away from their rental units. Additionally, management companies are well versed in local and state landlord-tenant laws, which can help landlords avoid potential legal issues. They also have established relationships with contractors and service providers, which can lead to cost savings on maintenance and repairs. However, it's important to consider the cost of hiring a management company. Fees can range from 5 to 10% of the monthly rent, which can eat into the landlord's profit margin. Therefore, landlords should carefully weigh the benefits against the costs before deciding to use a management company. Cash flow, maximizing returns through rental property investments. Cash flow in real estate refers to the surplus income generated from rental properties after deducting expenses such as mortgage payments, property taxes, maintenance costs, and vacancies. Positive cash flow is essential for real estate investors as it signifies profitability and financial stability in their investment ventures. For real estate investors, positive cash flow is crucial as it provides a steady stream of income, covers operating expenses, and contributes to long-term wealth accumulation. By maximizing cash flow through effective rental property management, investors can enhance their investment returns and build a sustainable income stream. To optimize cash flow rental properties, investors can implement strategies such as setting competitive rental rates, minimizing vacancies through proactive tenant screening and retention, reducing operating expenses through cost-effective maintenance and repairs, and leveraging tax benefits and deductions available to real estate investors. For beginners entering the real estate investment market, ensuring consistent and profitable cash flow requires careful planning and execution. Tips for beginners include conducting thorough market research to identify high-demand rental areas, setting realistic rental rates based on market trends, creating a detailed budget that accounts for all expenses, and building a financial cushion to cover unexpected costs or vacancies. Additionally, establishing strong landlord-tenant relationships, staying informed about local rental regulations, and seeking guidance from experienced real estate professionals can help beginners navigate the complexities of rental property management and achieve sustainable cash flow in their real estate investments. By prioritizing positive cash flow and implementing sound investment strategies, beginners can lay a solid foundation for success in the competitive real estate market. Principal, interest, taxes, and insurance. PITI. Understanding your mortgage payment. A mortgage payment consists of 4 main components known as PITI: principal, interest, taxes, and insurance. Understanding how each component contributes to the overall cost of homeownership is essential for property owners to effectively manage their finances and plan for the future. The principal portion of a mortgage payment goes towards paying down the loan balance, reducing the amount owed on the property over time. Interest, on the other hand, is the cost of borrowing money from the lender, calculated as a percentage of the remaining loan balance. Property taxes are local government levies based on the property's assessed value, used to fund public services such as schools, infrastructure, and emergency services. Homeowners insurance protects the property and its contents against damage, theft, and liability, providing financial security for the homeowner in case of unforeseen events. Each of these components plays a significant role in determining the total monthly mortgage payment and the overall affordability of homeownership. It's crucial for property owners to budget and plan for these costs to ensure they can comfortably meet their mortgage obligations. Understanding the breakdown of PITI helps homeowners gain a comprehensive view of their financial responsibilities and make informed decisions about their mortgage terms and property ownership. By managing these components effectively, homeowners can maintain financial stability and protect their investments in the long run. Buy low, sell high. The art of profitable real estate investing. The strategy of buying properties below market value and selling them at a higher price for profit is a fundamental principle in real estate investing, known as buy low, sell high. This approach hinges on identifying undervalued properties with the potential for appreciation and leveraging market trends to maximize returns on investment. Understanding and effectively implementing this strategy involves a blend of market analysis, property valuation, and strategic planning. Market timing and property valuation are key principles in the buy low, sell high strategy. Successful investors meticulously analyze market conditions, including supply and demand dynamics, economic trends, and interest rates, to identify opportune moments for purchasing properties at a discount. Property valuation techniques such as comparative market analysis, property inspections, and appraisal assessments are crucial in determining a property's true value. These techniques enable investors to negotiate favorable purchase prices, ensuring they buy properties below their market value. Executing the buy low, sell high strategy can yield substantial profits, but also comes with inherent risks. Market fluctuations, unexpected expenses, and potential losses if property values decline are significant risks that investors must consider. However, the potential rewards are equally significant, offering opportunities for substantial capital gains, rental income, and long-term wealth accumulation. To mitigate risks and maximize profits, investors should stay informed about market trends, network with industry professionals, and diversify their investment portfolios. For beginners, implementing the buy low, sell high strategy requires practical steps and thorough preparation. Conducting detailed market research to identify undervalued properties is essential. Working with experienced real estate agents or appraisers can help beginners assess property values accurately and negotiate favorable purchase terms. Staying informed about local and national market trends, economic indicators, and development plans can provide valuable insights for making informed investment decisions. One effective approach to buying low and selling high is to focus on distressed properties or those in need of repairs. These properties can often be acquired below market value because the current owner may be eager to sell quickly. Investors can then renovate and improve these properties, thereby increasing their value before selling them for a profit, a practice commonly known as flipping. Another strategy involves purchasing properties in up-and-coming neighborhoods. These areas might not be highly desirable at the moment, but signs of gentrification or development can indicate potential future appreciation. By buying properties in these neighborhoods at lower prices, investors can benefit from significant value increases over time. Market timing plays a crucial role in this strategy as well. Economic downturns or recessions can present opportunities to buy properties at a discount, as sellers might be more motivated to sell. Conversely, during periods of economic growth, property values often rise, enabling investors to sell at a profit. Recognizing and capitalizing on these economic cycles can enhance the effectiveness of the buy low, sell high approach. Finally, leveraging market trends can also be highly effective. For instance, the trend towards remote working has increased the value of properties in areas with good internet connectivity and attractive living spaces. By identifying such trends early and investing in these areas, investors can potentially sell properties at a much higher price later. In summary, the buy low, sell high strategy in real estate investing requires a blend of market analysis, strategic timing, and property improvement. By mastering these elements and staying informed about market dynamics, investors can unlock the full potential of real estate investing, achieving substantial financial success in the competitive real estate market. Margin. Maximizing profitability in real estate transactions. Margin in real estate refers to the difference between the purchase price of a property and its selling price after accounting for all associated costs, such as acquisition expenses, renovation costs, holding costs, and selling expenses. Understanding and accurately calculating margin is crucial for investors to assess the profitability of real estate transactions and make informed decisions that align with their financial goals. Margins play a significant role in determining the profitability of real estate transactions. A higher margin indicates a more lucrative investment opportunity, as it represents the potential profit that can be realized from buying and selling a property. By maximizing margins through strategic property acquisitions, cost-effective renovations, and efficient sales processes, investors can enhance their returns and build wealth through real estate investments. Accurate margin calculation is essential to avoid financial losses and ensure the success of real estate transactions. By accounting for all costs associated with acquiring, improving, and selling a property, investors can assess the feasibility of a deal, identify potential risks, and set realistic profit expectations. Failing to calculate margins correctly can lead to overestimating profits, underestimating expenses, and ultimately experiencing financial setbacks in real estate ventures. Margins can vary based on market conditions, property improvements, and investor strategies. In a competitive market with high demand, margins may be narrower, requiring investors to negotiate favorable purchase prices and add significant value through renovations or upgrades to maximize profitability. Conversely, in a buyer's market or when investing in distressed properties, margins may be wider, offering opportunities for substantial profits through strategic acquisitions and value-adding improvements. By understanding the impact of margins on real estate profitability, accurately calculating costs and potential returns, and adapting investment strategies to market conditions, investors can optimize their margins, mitigate risks, and achieve success in their real estate transactions. To begin your journey in real estate and build wealth, it's crucial to understand various home types, the intricacies of mortgages, and how equity grows through property appreciation and mortgage payments. Knowledge of renting properties for passive income, maximizing cash flow, and managing PITI, principal, interest, taxes, and insurance is essential. Employing the buy low, sell high strategy and accurately calculating margins can enhance profitability. By mastering these foundational concepts, you can navigate the real estate market confidently and achieve long-term financial security. Please subscribe, like, and especially share this video. Don't forget to explore related videos on our channel to continue learning and expanding your knowledge of the world of real estate. We look forward to supporting you in your real estate ventures to become a Realty Rockstar.